Happy Wednesday out there, Team 42. It's your skipper here, Darius to present our macro minute for Wednesday, November 27th, 2024. As always, we'll start with the executive summary from today's leadoff morning note. If you would like to review the analysis supporting these conclusions, as well as what specific changes you need to make in your portfolio to remain on the right side of market risk, you need to be a client of 42 Macro. So today's key macro question is, what matters more, the economy or policy? Our answers are, over the past 24 hours, various agencies released a barrage of U.S. economic data. The data are overwhelmingly supportive of our resilient U.S. economy theme and marginally supportive of our sticky inflation theme. It is not entirely clear whether any of this matters. What does and likely should matter more to asset markets is the uncertainty surrounding the size, sequence, and scope of President Trump's economic agenda. Regarding said agenda, Trump's latest three cabinet picks suggest tariffs and mass deportations will be a core feature of U.S. fiscal policy. In short, President Trump's cabinet picks and the sheer size and scope of the legislative sausage-making process should suggest the sequence of fiscal policy impulses upon the U.S. economy could prove negative for the economy and asset markets. Specifically, the risk of negative supply shocks from tariffs and immigration enforcement preceding the positive supply shocks from tax cuts, deregulation, and accelerated energy production is not immaterial. Transitioning to our 42 Macro dashboard. As always, we'll wrap up with the question from our community. This one's regarding Fed minutes reaction function. It says, hello, Darius. I was wondering if you might give us your thoughts on the Fed minutes yesterday. From my reading, it looks like they are downgrading their reaction function to employment as it is strong in favor of the reaction function to inflation. It sounded like they were trying to temper expectations for rate cuts moving forward. Would be very interested to hear your take on it, especially in light of today's PC prints. So I'll start by saying, I'm not really a huge fan of overly, parsing the Fed minutes. What you find, unless there's some real material change with respect to balance sheet policy on demand, and there was some important information on that. But generally speaking, the Fed minutes are kind of a hodgepodge of information. Our take on this is that typically the person that matters the most, and really, 95% of your focus, in terms of interpreting Fed tea leaves, are coming from the chair. The chair has an overwhelming influence on the direction and scope for policy. We saw a few times throughout Powell's tenure where Chris Waller and was it Jim Bullard had an outsized influence because of their sort of ability to forecast, changes in the balance sheet or, changes in the repo market and changes in inflation better than Powell. But generally speaking, you really need to only focus on what the chairman is saying, what the statement is saying, what the median dots, the median PCE forecast, the median unemployment rates, median GDP forecasts are saying. Obviously, there's dispersion. There's a lot of information. And what I'm trying to communicate to you in a admittedly long-winded way is that there is a lot of noise coming from Fed communications. There's a asymmetric bubble, exponential bubble in noise coming out of the Federal Reserve. And so if you want to extract signal from the noise, what we're trying to tell you is that you got to focus on what the chairman is saying, what the statements are saying, and what the median projections are in the dot plot and summary of economic projections are. And so that's, going back to the question, it is not our view that the Fed, more specifically Jay Powell, has downgraded the labor market and its reaction function. They're certainly less concerned about the labor market, as Powell communicated and a couple times since the most recent Fed meeting. They're a lot less concerned about the labor market than they were when they issued the September dot plot and cut the policy rate by 50 basis points back in September. So that at the margin is suggestive that we are kind of getting closer and closer to the point in time in which accelerating inflation, to the extent 42 Macro is right, that inflation is likely to accelerate over the next 12-month time horizon and generally surprise consensus expectations to the upside throughout that process. If we're right on that, we are inching closer and closer to the time with which, the markets may not absorb that information or that catalyst well. Right now, they're absorbing, upside surprises in inflation and generally, sequentially improving inflation pretty well, because they understand that the Federal Reserve is still trying to get the policy rate to a more neutral setting and may be on the precipice of a further reduction or a complete cessation of their fake QT program. And speaking of their fake QT program, arguably the most important part of the Fed minutes yesterday was the discussion surrounding the balance sheet policy. They explicitly called out the debt ceiling moratorium and the potential for a significant TGA spin down early in the year, and how that some of that TGA spin down may wind up on the Fed's balance sheet in the form of an increasing RRP, which would obviously offset that TGA spin down from a liquidity perspective. So they did recall that they did a 5 basis point technical adjustment to the overnight reverse repo facility rate lower, so that the Fed's balance sheet is less attractive to money market fund participants in the context that there's a significant reduction in the TGA in the coming months, which is something we are continuing to forecast until further notice, until Congress potentially punts on the debt ceiling moratorium, which they very well may. I mean, they're going to use budget reconciliation to change the they're going to use budget reconciliation to enact the tax cuts that President Trump has promised on the campaign trail. And in the process of budget reconciliation, you can actually lift the debt ceiling and bypass the sort of filibuster of the 60 vote account. However, the Democrats might not decide to punt on the debt ceiling. If they do decide to punt on the debt ceiling moratorium, i.e. push it further into the future, the current moratorium into the future, that would obviously delay any TGA spin down associated with, kind of reaching the statutory debt limit. We're already there, associated with the U.S. Treasury running out of borrowing authority. So this is a real, there's a lot of moving parts, if you can't tell. And this is only one narrow slope of the things that matter to asset markets. You're talking about trying to get asset markets right. You got to get growth right. You got to get inflation right. You got to get monetary policy right. You got to get fiscal policy right. You got to get the positioning cycle right. A corporate profit cycle is really instrumental as well. And then obviously you got to get liquidity right. And I would argue liquidity kind of is the outcrop of growth, inflation, monetary fiscal policy, and corporate profits. So that's kind of the outcrop of that. But you got to get all this stuff right if you want to have, consistently stay on the right side of market risk. The alternative, which is the more humble, more thoughtful, in my opinion, way that we've chosen here at 42 Macro is yes, we're always at all times trying to forecast all of that stuff, but the signals that matter most, that signals that actually matter to our asset allocation and portfolio construction recommendations that we use to keep our clients on the right side of market risk at all times, are our quantitative risk management signaling. Our quantitative risk management signaling processes like KISS and Dr. Mo, they are a mission that there's no way possible for someone who is even as talented as I am at predicting all this stuff is going to constantly predict all that stuff correctly. So if you're less talented than I am at predicting that stuff, you have to accept the fact that you're probably going to have even more tracking error with respect to your forecast error with respect to your projections for all those different cycles that impact asset markets than even I would have. And I've already decided to listen to the market and let the market dictate our asset allocation and portfolio construction. So, we'll wrap it up there. And as you sort of, assuming you're here in America, and even if you're not in America, over the next few days, I want you to be really critically thinking about what I just said about, incorporating more humility into your investment process, accepting the fact that you are not smart enough to predict all of those cycles that we just talked about consistently and accurately over the course of time. What you can do, however, is find ways to incorporate more quantitative risk management signaling into your process so that you can listen to the market and participate in raging bull markets like 42 Macro clients have for the past couple of years, or you can get to the sideline and or short heading into raging bear markets like 42 Macro clients did back in 2022. There's a reason we have a phenomenal track record over the last 3.5+ years. It's because we have the humility to accept the fact that we can't predict all that stuff consistently and accurately, and that the market is smarter than us, and that we should be following the market and participating in what the market is trying to price in at any given juncture. That's a much better outcome than, trying to tell the market what to do based on your fundamental predictions, which may or may not be as, deeply researched as ours are here at 42 Macro, and everyone in the world knows how deeply researched our fundamental research views are. So we'll wrap it up there. Everyone have a wonderful Thanksgiving holiday break. That's tomorrow, and then we will be offline. I'm giving our firm the Friday after Thanksgiving off in perpetuity. We will have 2 holidays that aren't recognized national holidays until I'm become president at some day. One, the day after Thanksgiving should be a holiday, Black Friday, and then the Monday after the Super Bowl should be a holiday, It's crazy to me that it's not. So you won't be hearing from us ever the Monday after the Super Bowl or the Friday after Thanksgiving. So we'll catch you back here on Monday, December 2nd. Everyone have a wonderful holiday with their family. If you're not celebrating, just have a wonderful rest of your week. Great weekend, and we'll catch you back here on Monday. Cheers.